That's a really good question. And so one thing I do is I go look. I kind of I love these long-term data sets. And so when I hear about how something works, I say, okay, let me go and test that. Let me see how that's actually done in history. And so I go look at the data, and then from there, you have to watch out between correlations and causations, right? So you have this data set. So you have this idea, first of all, like a narrative, but everyone's got a narrative, and they say, okay, how does the narrative apply to the data? Then if the data looks good, you have a narrative and a data, and then you kind of stress test it. You say, well, why did this happen this way? Could it have happened this way? And so I try to figure out, what is the actual point of causation, and what are kind of the bottlenecks in the system? Where does something break if it doesn't work like this? And that's actually a really big role in, for example, those giant debt cycles, because usually they have their turning points when things are basically stretched to their absolute limits. And you basically say, okay, if this doesn't happen, then this other thing happens, and that's even worse. And so you kind of watch this kind of play out. And so, and I also incorporate, for example, some of the socio-political stuff, kind of like judging what sort of policies likely to happen. And I often formate things as kind of an if-else equation, where it's like, okay, here's the long-term base case, here's where the breaking points seem to be, but there are a couple decision points ahead that are worth watching. And so, for example, one of the decision points I was watching was, back in 2019 or so, I was okay, when we have an next recession, we're probably going to have a very big fiscal response, just because there's almost nothing else they can do in terms of monetary policy. We're probably going to get a lot of fiscal policy. But then the question was, when March, for example, is playing out, it's like, okay, let's see how this goes. And then so it's kind of like we're watching the decision points play out and saying, here's what I think is going to happen, but we have to actually see it if it's going to materialize, and then adjust if certain things start to happen. And so, I try to incorporate the political realities into any sort of forecast that I do, and always think in terms of probabilities, base cases, kind of understanding points where it could start deviating from the base case, and kind of map it out like that, and then change as we go along. And so, for example, I have, say, a model, but then I'm also actually watching indicators in rate of change terms, economic indicators, and seeing what's actually happening and kind of adjusting the model as new data keep coming in.
Can you give me an example of a time where the data has said, oh, my model was wrong, I better change my course?
Well, an example was, I was actually surprised at the kind of the sharp turn between, say, gold and equities last year. And so for example, saw that gold was likely to roll over because, real interest rates were coming off of their bottom. And I was actually surprised, though, at how strong the equity market did, during that time period. I kind of thought that, they both might have a cooling off period, but equities still kind of went up, more than I would have guessed. Same thing for, some of the growth stocks, the kind of the unprofitable stay-at-home growth stocks, how they kind of had that really big peak in 2020. And so, a lot of things they looked overvalued, but then they got, in many ways even more overvalued. And so that's one of those things where valuation tells you an idea of what the long-term potential is and kind of what some of the risks are, but it doesn't, of course, tell you what's going to happen in the next 6 months or so. And so generally the where the model kind of usually falls short is often things go, say, further than expected, and longer than expected before they kind of eventually revert to the model. I think another case was that I became a kind of a long-term dollar bear starting in October 2019, and that was because of the repo issue. And so that was an area of my work was really useful, because a lot of people were kind of debating on what the repo issue was, and my model is very helpful kind of guiding through that and kind of figuring out what that was. And so I became more dollar bearish. But then, of course, the pandemic came in the early 2020s. We had the economic shutdown, and of course, because there's so much dollar-dominated debt out there, we had that dollar spike. And so basically, we had these like multi-month deviation from what was otherwise a dollar bearish trend starting to form. And so that whole thing took a couple extra months until we actually saw the down leg eventually happen. And so that's an example where you can have a model, but then a real world event comes and says, okay, your model aside, we're going to push that whole thing back 6 months because it's the real world.
All right. Well, I don't want to go too far down that rabbit hole, but since you mentioned it, repos are the buzz is back on that. Do you have a quick take on the current kerfuffle about the repos?
It's often like a T-bill versus bank reserve issue. And so the issue back in late 2019 was that there were not enough bank reserves compared to how much T-bills were being issued. And so basically they had to essentially revert to deficit monetization. They had to start expanding, the Federal Reserve had to start expanding their balance sheet to buy T-bills. And what we're seeing here in 2021 with the reverse repo situation is banks have been so stuffed full of reserves that they almost have too much reserves, and so they're kind of giving some of that back to the Fed with these daily reverse repo operations. And it's actually somewhat similar to what we saw back in 2014, which is when they were kind of finishing up their last leg of QE3 from that previous cycle, where banks were similarly really stuffed with reserves.
All right, so do you draw any conclusions from this reverse repo? There are a lot of people saying, oh, this is going to change everything, or is this just tinkering under the hood, as the Fed says?
I think it's another one of those decision points. And so, for example, if you look back at the 2014 period, that was kind of their signal to eventually slow down QE and basically, they flattened out their balance sheet for a number of years. And when that happened, that was a big contributor to the dollar going up compared to the euro, compared to other currencies. That was kind of a tightening event, and that contributed to some of the pain we saw in emerging markets and commodities over the next couple years. That stronger dollar, because it puts a lot of kind of tightening pressure on, say, emerging markets, which is where actually the majority of global GDP comes from now, GDP growth. And so basically that's kind of the issue to watch out for, is if they were to say tighten faster than markets expect, you could get that dollar move, and a lot of this big reflationary cycle kind of rolls over for a period of time. The other option is that they're exploring things like increasing the types of standing repos they have, the standing facilities they have. So they basically make some of these facilities more permanent and broad. And so I think they're generally going in that direction, where they're because basically the situation's worse than it was in 2014. They're unlikely to repeat some of those same issues, but it is something to watch for decision points to see. Okay, if say the dollar bear thesis for the next couple of years is like a base case, but I can envision a scenario where we detour and have like a dollar spike until they have to reverse course again. And so it's basically trying to monitor things in rate of change terms, pay attention to what the Fed's talking about in terms of these facilities, and kind of updating as we go along.
All right, so monitor. You're not seeing it as something that's already a done deal. There's people that are saying this is a stealth Fed pivot already. You don't buy that?
Well, I think they certainly have an issue there. But for example, when you look back at that 2014 period, they ended up doing reverse repos for like 4 years. The whole kind of 2014 to 2018 period, they were just doing tons of reverse repos. And so they can actually do this for quite a long period of time. They start to run into issues if it gets really big, which we're kind of in the process of testing. And so that's kind of a whole separate discussion.